Good afternoon, everyone, and a very warm welcome to today's session on cybercrime, insuring risks and recovering funds. My name is Leonie Parr. I'm a partner here at Field Fisher in the Privacy, Security and Information Law team. We have quite an interesting lineup for you today. We have a number of speakers. We first have Stephen Cartwright, who will walk you through a real-life incident where we helped a client recover funds. Then we've got Tony Lewis, who will review some of the developments in law and the tools available to businesses in the event that they're forced to pay out ransoms in cryptocurrency. And then thirdly, we have James Seaton, who will canter through some of the other practical considerations that you should think about if you suffer a cyber incident. And finally, James Walsh will discuss cyber insurance and the practicalities of insuring for losses arising from cybercrime incidents. But before we begin, just a few housekeeping issues. So we will invite questions during the presentation. So you should be able to see a window for questions in your GoToWebinar drop-down menu. And I'll keep an eye on questions during the course of the presentation, and I'll either raise them in real time if that seems appropriate, or else we'll try to address them in the Q&A section at the very end. Throughout the course of the session, we'll be running a few interactive polls, and please do contribute to those. None of the results will be attributed back to any of the participants, but if there's a good turnout, we hope that the responses will provide some helpful talking points throughout the discussion. And so without further ado, I'll hand over to Stephen.
Thanks, Leonie. Thanks all for joining this afternoon. I'm a senior associate in the fraud and financial crime team, and we often deal with victims of cyber attacks or push payment frauds who come to us where they don't really understand what to do to get their money back. And often when funds go offshore or into certain accounts and certain assets, it's easier to assume that there's no chance of getting anything back. So to start things off, to keep things interactive, I would like to set out a quick poll. And the question is, would you know what to do if you lose money as a result of a cyber fraud? So please vote, and we'll then discuss a real life example of a case we've just had and had an interesting outcome in the last month or so. Probably as expected, and the people who are yes 100% confident, then you can nod along to the next few minutes, and hopefully we've done we're all joined up. I think a lot of people always anticipate and are hopeful that there's some prospect of getting assets back. Often they consider pursuing the criminal route first, and as 27% of people have suggested they haven't got a clue whatsoever how to get funds back. I'll just run you through a case which has cyber elements and elements of a push payment fraud that first came in. It was actually 2 weeks into my role at Field Fisher when we were learning about where the fire escapes were and trying to understand how the coffee point operates. And we received a call from an Italian high net worth individual who had 15 million euros in an offshore bank account in Cayman Islands, and the account was drained. It came to light when their fiduciary operator reviewed the monthly bank statement out at the end of the month and noticed the transaction to a bank account, a Barclays bank account in Leicester. All they knew was the Cayman Island Bank had received a forged fax using information which later turned out to be potentially from a data breach from our clients' holdings, and 2 phone calls, which I'll flag because that's an important part for later, which perpetrated the frauds. And somehow someone in the Cayman Islands that day was either hungover or not paying attention, but allowed this transaction and validated it and allowed the funds to go. So what do we do? The first thing is we've got metrics here because the account was a UK bank account. So we immediately looked to stop the flow of funds. Obvious reasons once the flow of funds is stopped, then you can look at the pieces. But we don't know who the account holder is. So what's a relatively new jurisdiction which has been developed in the last 2 or 3 years is what's called persons unknowns freezing injunctions. And that line of jurisdiction comes from cases involving, including the J.K. Rowling case about a stolen manuscript. We don't know who the injunction should be against, but you know the category of the audience that you can define. So in this case, it was the account holder at Barclays. So we instructed counsel, went to High Court, got a freezing injunction against this unknown account. And part of the benefits of that is you're able to not just stop the flow of funds, but introduce what's called no cause of action defendants who give disclosure about the account holders and onward transfers, and they're predominantly banks. So if I skip to the next slide, we'll see what we learned from that experience. Now, this might give you a headache, and color coding is very useful. What you'll see now is 15 million euros coming from the top of the chart, flowing through. Fortunately, we had 1.3, which we hadn't left the account, and we managed to block that in time. Then 2 separate tranches of 5 million euros were transferred to sterling and then fanned out to various organizations, and then a number of smaller transactions. And the starting point, the 15 million was received by this Barclays bank account in Leicester in the name of a company called the Family Officer Limited, which is an organisation based in Mayfair in London, run by a Mr. Matteo Cherry, which offers financial and other services predominantly to the Italian industry and Italian nationals based in London. So what was Mr. Cherry and the Family Officer's defence for receiving this amount of illegitimate monies into their account? Well, Mr. Cherry claimed that he was acting on behalf of a legitimate businessman, and he'd been approached and he was expecting an investment. A defence to receipt of funds here could be that Mr. Cherry was a bona fide recipient and he was offering services and that there was value to that. So the onward transfers are allegedly part of that investment plan. But that defies a degree of commercial sense. Why would the alleged investor pay money in this way and allow those monies to be distributed in such a broad sense and also connected to Mr. Cherry's business? But what could we do to ensure that our assumption was correct? So we got the freezing injunction, and within 6 weeks we managed to get certain orders and prove certain evidence that encourage 11.5 million of the 15 to be returned back into our client's bank account. So far so good. That's a great result, but now we're still £3.5 million out of pocket, and interest accrued and legal costs to get to this point. So what we want to look at is how we can get how to defeat Mr. Cherry's evidence. And the first line of questioning we looked at is using what's called Norwich Pharmacal orders. I'm not sure how many of you have come across them, and they're very wide-ranging, but I think incredibly useful legal devices to gather information. And in this case, recall there were 2 telephone calls out to the Cayman Island Bank at the time of the perpetration of the fraud. So by looking at the telephone number that was recorded as a UK number, and it was actually linked to Vodafone, which you can look at by looking at the first few digits of the mobile phone number, we approached contact at Vodafone and asked them what sorts of information they have that can be shared with us. And obviously the answer immediately was nothing without a court order, but we worked with Vodafone to get a court order in easy terms. It was actually dealt with on paper without a court hearing. They got us information on the cell towers that we use, the closest cell towers used for the call, the call history and the log of various calls, where the mobile phone and SIM card were purchased, and importantly also the information on the debit card, prepaid card that was used to purchase the phone. So we found out firstly the closest cell towers to these two calls. Well, there was two calls. The first call, the closest cell tower was literally across the street from the family office's office in Mayfair, 90 meters away. We learned a lot about how cell tower trigonometry works in this case. And if you're based in London, it could be a matter of 100 meters or 200 meters near a cell tower. If you're based in rural Cumbria, it could be a number of miles. So this gave us a large sense that we were on the right tracks, but it could be someone sat outside his office trying to pretend to be him, or it could be a pure coincidence because obviously London's a busy area and this is a part of London where these there's a lot of industries, lots of businesses in this industry. So looking at the second call, we noticed that the cell towers effectively were handshakes, and they showed a movement of the closest cell tower, which suggested that the caller was in a moving vehicle, possibly a taxi, from Old Street to Mayfair. So that then dispelled the argument that someone was trying to set up Mr. Cherry and the family officer, because why would someone make such an unusual journey and assume that we would get this level of information if they're trying to set him up? But this in itself is only one part of it. We then looked at the Norwich Pharmacal order against the prepaid debit card that purchased the phone. We found out it was a Revolut bank account, Revolut card, and again, working with contacts at Revolut, we managed to get a court order that's allowed us to get information on the purchase of that account and account information around that. And it turned out the purchase of the SIM card and phone was a junior employee of the family officer. And what's more, the day before the purchase of the phone, Mr. Cherry personally transferred £200 to his junior employee's Revolut card. And pausing there, I think we'd say that if there are many lessons to be learned today, one of them is if you're ever going to commit a fraud and use a burner phone, I suggest with the Norwich Pharmacal order out there, you can make sure you try and use cash. Unfortunately, our fraudster fell foul of that page 1 of the handbook of how to perpetrate and buy a burner phone. But then it shows what we do, what that leads us to. And we're looking at getting summary judgment to speed things up so we can minimize legal expenditure, get a prompt outcome, also so we can start enforcement as soon as possible, so to preserve the flow of Mr. Cherry and the family office's assets to stop them being hidden from creditors. The mobile phone evidence is very helpful, but the threshold for summary judgment in fraud cases is incredibly high. So we then looked at a series of emails that were received by Mr. Cherry, and the allegedly instructions from the vice president of the fiduciary company, giving him instructions what to do with the funds. And we originally received, I think, 6 emails allegedly from the vice president, and by looking at the metadata in the properties of the emails, if you think how you right click and you go into properties, there's a load of code there. It doesn't mean too much to most of us, but if you on this particular one, we looked and there was a reference to what's called MKI's mailer, which is a Czech website. It's designed specifically for spoofing emails. And as you can see from this slide, anyone can input an address and a name and send an email of any content purportedly from that name to any other individual. So you could potentially set up an email using Donald Trump's account, send it to a president of any country of your choosing, and say whatever political message you want to say, and sit back and watch the entertainment happen. This was obviously useful information to show this was a scam, but Mr. Cherry's defense was, well, how would I have known? I'm not expected to be able to check the metadata of emails received. I was relying on face value. And to a degree, we would all sympathize. But 2 of the emails that were shared with us were responses to emails that Mr. Cherry had allegedly sent to Lorenzo Sacchi at the fiduciary company. And here's an example of one of them. It's all in Italian. I don't expect anyone to understand the content, but the relevant part is this email chain was received by Mr. Cherry undeniably through a spoofed website. So the author of the spoofing would have to have seen this email, which either meant that the email was genuinely sent by Mr. Cherry and hacked and intercepted on the fiduciary company's systems, or most likely Mr. Cherry was the author or in a co-conspirator with the author of this spoofed email. And by looking at the forensics of the fiduciary company's email system and their IT server, it was clear that no such email was received by Mr. Cherry. And this information really got us home and dry in court last month to be awarded summary judgment for the remaining shortfall amount of €3.5 million plus 2 million euros of cost to ensure that we have wrapped up this aspect of this litigation and can look at enforcement and potential other third parties who might also have a degree of liability in this. So what have we learned? I think the first thing is, if we did the poll again, hopefully the answers are slightly more positive of what we could do, and the hope that people can have that funds that have gone out of a bank account, and what's more, these funds flowed across many jurisdictions. I think there were 8 different jurisdictions across the world. We are able to domesticate court orders, and we're able to work with local counsel in these jurisdictions, and where appropriate, for example, in Austria, to set up criminal proceedings as the quickest way to freeze assets. The important message is, if you're a victim of cyber fraud or any other fraud and you lose funds, there are legal tools out there through Norwich Pharmacal jurisdiction, freezing injunctions, and other that can allow you to get that money back. And this is a great case example of what things we can do. Moving on to my colleague Tony Lewis, who will explain a bit more about how all is not lost if we go into the crypto world.
Good afternoon, everyone. My name's Tony Lewis. I'm a partner at Phil Fisher, and I head up the fraud and financial crime team. And we get involved in a lot of asset tracing matters, as Stephen's just identified. I don't think I'm on the billing. I'm standing in a late stand-in for my colleague, Alex Underwood, who wasn't able to join us this afternoon. I'm just going to spend a couple of minutes, as Stephen foreshadowed, talking about where cyber touches on the crypto world, because the example that Stephen gave was a good example of the sort of work we get involved in. But in some ways, it was quite plain vanilla in that all the monies went through the traditional banking system. So what we were faced with was simply movements from one bank account to another. And bank accounts obviously have account holders associated with them. So there's a relatively easy chain to follow. Now, what we've seen increasingly as fraudsters become more sophisticated and cyber criminals are thinking of new ways when they take assets to try and hide them. And we're seeing the rise of crypto. That's quite often on the ransomware side, where ransoms are paid in Bitcoin or other cryptocurrency, but also sometimes traditional fiat currencies are then quickly exchanged into crypto to try and hide the chain. And of course, crypto is generally anonymous, and therefore fraudsters like it as an asset. Now, most people, I think, know what crypto is. People think usually of Bitcoin. That's sort of most well recognized cryptocurrency, but there are of course many cryptocurrencies, and each one, slightly differs depending on the way it's set up. But essentially, crypto is nothing more than a pair of sort of data parameters. You've got a public aspect to it on the one hand, where there's information recorded about ownership, value, and transactions, and crucially that's held in a public way, so that there's no one custodian of the information. It's actually held by every ledger on the database, i.e. everybody. And then you've got a separate data parameter, which is a private side, which is the key, if you like, which unlocks the ownership, and that key can be transferred and a record is then made on the public side when there's a transfer. So that's very broadly how it works. That causes a conundrum from a legal point of view because there's been a lot of uncertainty about whether or not that constitutes property. Real property is obviously easy to identify, bank accounts easy to identify, but crypto sits in that sort of hinterland. And so for a time, there was uncertainty as to whether the courts were going to recognize this, because traditionally the courts would recognize either shows in possession or shows in action. Shows in possession is something you can touch and feel, and shows in action is property where you can make a claim against a person for that particular right. The difficulty with crypto is that there's no claim against any one individual because of the way there's a decentralized public record of the rights. So the courts have sort of grappled with this, but luckily a couple of recent cases have got us on track in terms of catching up with the fraudsters, because the court is very much coming down on supporting the victims and decisions which show that orders can be obtained and recovery made of crypto assets. So a couple of cases I just wanted to flag very briefly. The Robertson case, we go back to the end of 2018, 2019. This was pretty much the first case where the court considered crypto. An individual, Mr. Robertson, was looking to transfer some Bitcoin, and a simple phishing attack, somebody intercepted an email, social engineering, and Mr. Robertson unfortunately sent the Bitcoin to the hacker's account. He acted fairly quickly and managed to persuade the court that that was property and he should be entitled to get a freezing order over that Bitcoin. And in fact, he managed to get it back in that case. Then more recently in AA versus Persons Unknown, and that's not AA, Automobile Association, that's meant to be an anonymized insurer, although it was an insurer that was subject to a ransomware attack, and their systems were effectively frozen by a cyber attack, and they paid a ransom in Bitcoin. It was about, I think it was about $1 million they paid to get the release key. They got the release key, but then they wanted to try and get their Bitcoin back. And so they went off to court and went against the Persons Unknown and in fact the custodians of the Bitcoin, and again managed to persuade the court that there was a property interest there so that they could have a proprietary claim. And just pausing there, the importance of showing a property interest, a proprietary claim, is that effectively you can then trace through monies and assets that represent your assets and effectively identify your property to the exclusion of other creditors. So when we're looking at recovering assets, we're always looking for property claims rather than debt claims, because debt claims can often run into the sand quite quickly. There's another very recent case, actually, I think it's only a couple of weeks old, Iron Science versus Persons Unknown. There, the court looked at another conundrum in the crypto world, which is what's the proper jurisdiction for these sorts of claims? Because the nature of the public ledger being on every computer on the network across the world, then there's uncertainty as to which is the right jurisdiction. But you don't typically get that issue when you're tracing because assets tend to be more tied to a particular jurisdiction. So the court, again, helpful decision because they've said, we'll look at the where the victim essentially lives, and so that gives hope for victims who are based in this jurisdiction that they can use the English courts to get the sorts of orders that Stephen was talking about. So the sorts of orders that Stephen mentioned, the freezing orders, the Norwich Pharmacal orders, these are all things that we can obtain once we've established that there's a property interest and there's a jurisdictional hook here. So it's very powerful, and you will have seen that each of those cases is also against Persons Unknown, and as Stephen mentioned in his presentation, the Persons Unknown jurisdiction is itself quite a new idea in the courts last 3 or 4 years. So what we're seeing is that the legal process keeping up with the fraudsters. And the great thing about Bitcoin actually is once you've established that it's property, the tracing side is really quite straightforward in that the nature of the blockchain is that you've actually got a record of where that asset is going. So unlike successive bank accounts where it can be difficult to follow in different account holders in different jurisdictions, once you're into crypto and the blockchain, actually the trace exercise becomes quite easy. And then when you add on to the fact that you'll often have intermediaries and custodians involved in helping to trade Bitcoin or to hold Bitcoin or other crypto assets, such as Coinbase is the big one where a lot of people trade. You've got other intermediaries that you can also go against for information and so on. So I think that the takeaway is that the court process can assist where you've been a victim of a cyber attack. There's real hope to think that the court process can help you recover the proceeds, whether they're in traditional currency, traditional assets, or indeed in crypto. I will hand on to James. Thank you.
Thanks, Tony, and indeed Stephen, for illustrating how our experience at the cutting edge of this area of law can help recover funds in very tricky circumstances. It's a welcome part of our armoury for clients facing cybersecurity incidents. I've been asked to say a few words about the key considerations during an incident, and maybe particularly well placed to do so, in addition to being one of a host of partners here at Field Fisher who help clients with cybersecurity generally, and particularly incident response and the regulatory inquiries that follow. I also lead our specialist data disputes team, handling the follow-on litigation. Let's start though with a quick poll, please, and you can use the platform to answer this question as before. So do you think your organization has suffered a data breach in the last 3 years? And you can answer yes, no, or don't know. And while you do so, I'll say this part of our webinar might be a recap for some of you, but for others fortunate not to have had to deal with a major incident, it might be newer territory. I hope there'll be something for all of you though. But as with all the other talks, feel free to submit any questions through the platform, and we'll look at them later. Right, let's see how we are. I think a majority of you have voted now, and you think, okay, so about just under 60%, 57% think you may have suffered a data breach. A quarter of you think definitely not, and 20% or so not so sure. Right, let's turn to the outline of a typical incident response. I won't dwell on this slide for long, but you'll understand the general pattern from the initial battle to understand what's going on through damage limitation and recovery to the legal and commercial consequences. The orange text illustrates one of many legal considerations you have to think about, and that when you're engaged in all of these work streams on the slide, the question of whether or not you have to tell the regulator or wider world about your data breach, that clock starts ticking very early on. So imagine it's 5 o'clock on a Friday afternoon. It's an old chestnut, but many cyber attacks are timed to exploit people's minds turning to the weekend. You hear of a successful ransomware attack shutting you out of many of your systems, and you don't know yet what's been saved and what hasn't. Perhaps even your backups are at risk. And by the way, if you don't know right now whether they would be, that's an important question to think about today, not when disaster strikes. In addition to containing the damage, recovering your systems, and protecting the business, you now have 72 hours or so to decide whether or not you have to tell one or more data protection regulators what's happened. And as I'll explain, this is why planning ahead is critical. But to answer that big GDPR question, you'll need to consider a whole host of others, which this slide illustrates by reference to a notional telecoms business. And amongst those questions, firstly, you have to think about if people's personal data is affected, where are those data subjects? Moreover, where is your business, your businesses, where are the servers, what laws apply to you? Building from that, what regulators are engaged? Which country's data protection authority or authorities? What about regulators in other sectors? Telcos, for example, have obligations under the NIS directive, but other businesses might be regulated by the FCA or another authority. Are you a data controller or a data processor in respect of the data that's been affected? And that controls your obligations, as we'll see shortly. You might have contractual obligations to think about in addition to statutory law. And before you get too far with any of those questions, you really also need to work out whether the incident qualifies as a data breach at all and whether it is just a data breach. For simplicity today, I'll focus mainly on UK data protection law, but in a real incident, don't lose sight of the rest, whether it's criminal law issues, as you've just heard, or something else entirely. So to work out whether you're dealing with a data breach, first you need to know what personal data is. This slide sets out the GDPR definition. Key thing to note, and I'm not going to read it to you, these slides will be available later, it's a very wide concept and can even extend to things you might not expect, including things like IP addresses and pseudonymous data, even hashed or encrypted data if it can still be used in some way to re-identify the individual. That's personal data. What about a personal data breach? This slide has the answers. And again, the definition is much broader than people tend to expect. Scenario 1 on the right is probably the classic data breach, similar to what we've been hearing about, but here a hacker gets into your systems and takes data. But in fact, all 3 scenarios, and of course many, many more besides, are personal data breaches for the purposes of the GDPR framework. It certainly doesn't get you off the hook if personal data isn't stolen. You'll see from the box on the left that a personal data breach is any breach of security that leads to the accidental or unlawful destruction, loss, alteration, unauthorized disclosure of, or access to personal data. It can even be something like a temporary loss of availability of the data. And so with that ringing in your ears, let's try the same poll again. So please use the platform to answer once more, now that you've thought a little bit more about data breaches, whether you think your organization has had a data breach in the last 3 years. I'll give you just a couple of moments more to contribute. And I think we're into a majority of you there, so thank you for voting. And as you'll see, numbers have increased a little bit. For those of you who think you have had a data breach or are sure you've had a data breach, now up to 70%, only 10% of you unsure, and the no's have dropped a little bit. I think that's probably entirely expected. We're all familiar with the general concepts of a data breach, but there are many more that slip in around the edges, and it's important that if you're practitioners or business people dealing with these things, that you understand where the edge cases are. So this slide summarizes one of the most pressing data breach questions. Do you actually need to tell anyone about it? As I've said, the answer differs on whether you're the controller of the affected data or processing it on another controller's behalf. And to answer the question, you might need to decide pretty quickly, and to standards you can later defend if you're asked the question by the regulator or by a litigation counterparty, whether the breach is likely to result in a risk of harm or a serious risk of harm to the rights and freedoms of the affected data subjects. If you're a controller and there is such a risk, then you need to tell the data protection regulator, the ICO here in the UK, as I'm sure you know, about your breach without undue delay and probably within 72 hours of detection. If legally speaking it's a high risk, then you might also need to notify the data subjects themselves, and again, without undue delay. If you're a data processor, on the other hand, you don't need to decide whether to tell the ICO or to tell the data subjects. You don't even need to assess the risk of harm. Your duty is simply to tell the controller about the breach as soon as you can, so it can start dealing with these points itself. Now, that sounds really easy, but in practice, what outsourcing or other business wants to tell all of its customers about every minor slip or incident affecting data where there's no threshold of seriousness? I think the answer is none of them. Moving on, you're probably now wondering how you decide whether a data breach presents a risk of harm that would mean you need to report it. And this slide sets out the type of risks that you have to consider in making that assessment. And if we move on to the following slide, I've also set out some of the factors that will determine the severity of the risk. If you're looking for a guide through every possible type of data breach and every ramification here, then I'm afraid the bad news is that that's far beyond the scope of today's talk. But the good news is that not only do we have a wonderful team of experts who can guide you through these decisions if you're in a crisis and follow up with you after today if you have questions, but we also have a user-friendly tool that we've developed based on the regulatory guidance, and we can sell that as a precedent to help you make the assessments yourselves if you prefer. This isn't a sales pitch though, and we'll move on to the next slide. Most of you will be very familiar with the strong commercial and other reasons why it is so important to get your incident response right. In addition to those headline-grabbing GDPR fines, other substantial risks include things like reputational impact, a growing trend of litigation, including the spectre now of US-style opt-out class actions. Indeed, right now, as we speak, the Supreme Court, yesterday and today, is hearing arguments in a case brought against Google that might pave the way to more claims of that nature. The next two slides are included really so you can reflect on them after today's talk. The first sets out some of the common themes that we've identified in regulators' reports where they have taken enforcement action following a breach. And in the right-hand column, we've set out the behaviors that can help you reduce or avoid enforcement action at all. As you can see, it's getting your response right, taking a collaborative approach with the regulator, but telling the right story that is critical. Similarly, this next slide shows some of the common failures that we can identify in organizations that don't handle data breaches so well. I should clarify, of course, none of these at all apply to any of our own clients. With our guidance, they are exemplary in their incident handling, but it's planning, allowing for a decisive response when disaster strikes that makes all the difference. So that is the central data protection issues, although of course any incident will have complexities beyond those key themes. But what other legal issues must you think about in the heat of the moment? Again, having a plan that reflects these will make all the difference to your incident response. So for example, you need to consider safely preserving information. You'll need this. You'll need to answer regulatory questions or to avoid inferences being drawn against you in litigation. But at the same time, you need to ensure that your records aren't unnecessarily vulnerable to disclosure to adverse parties. You might well need forensics or other support, and getting their instructions right from the outset, ensuring reports are written in the right way, might make all the difference in keeping uncomfortable conclusions away from the wrong eyes and out of the wrong hands. And that last line on the slide, in my experience, it's all too common in a crisis for the incident to be quickly identified as a fraud or as a data breach or as something else. But in reality, many of these incidents combine several areas of law. For example, a business email compromise leading to payment fraud. It's probably going to be a criminal fraud issue of the type Tony and Stephen have been talking about, but it's also likely to be a data breach. And if you spend your 72 hours working out how to get the money back and only how to get the money back, then you might find yourselves under very great pressure on the data protection front. Similarly, data security incidents might also mask, for example, a misuse of your company's IP, trade secrets, confidential information, database rights, or whatever. So there's an awful lot to get right in a hurry. It's why having a good incident response plan and testing it against a range of scenarios, doing so regularly, ensuring it will work when it's needed most, is so important. I won't spend long on these last two slides, but this one sets out the themes that you'll likely want your incident response plan to cover. And last of all, who might you need to call upon in the heat of the moment? Again, it can make all the difference to have relationships established well in advance of things going wrong, or at least to have a decent list available in the organization so your teams know who to call when that does happen. And we can help not only with that specialist legal advice in the heat of the moment, but also with many of those relationships, but there is still no substitute for planning ahead. And on that note, I think you'll next hear from James Walsh on one of these 12 topics, and that is cyber insurance. Thanks.
Thanks very much, James. Now, as you can see, the risks of cyber are real, and there's probably no need for me to reiterate that, given that we've now established that 70% of the audience have suffered some sort of data breach in the last 3 years in their organizations. Now, what I've set out here is some of the headline financial losses, and I think it's important to balance a range of different losses that businesses can actually suffer. Now, we've focused today on some of the key financial losses that arise in cybercrime incidents. So clearly, ransom payments are on the rise. You've got some statistics there claiming that in the UK we're paying out about £200 million a year in ransom payments. We've also clearly got examples of invoice fraud. So, for example, there's one on the slide for the Mercy Care NHS Trust, which became victim to a £1 million fake invoice fraud. The incidence of fraud can actually rise significantly, and there's still a lot of work being done on Wirecard's demise after about $2 billion went missing amid fraud accusations. Now, what we also have is a wide range of data protection fines, and of course, Marriott and British Airways were both fined tens of millions of pounds as a result of a data breach by privacy regulators. What some commentators estimate is that around $4 million is the average cost of a data breach, and so it's worth therefore treating this as a key board level risk in your business. Now, one of the key ways that you can deal with this is by looking at your insurance. Any other business risks of this magnitude you would expect to have insurance for, but actually in recent memory, specialist cyber cover was not that common. So if we go back to 2019, the Association of British Insurers found that only 11% of UK businesses actually had specialist cyber cover in place, despite cyber insurance payout rates ranking at around 99% of all claims made. Now, I suspect that things have actually changed since then. So I'm going to run a poll now for the audience just to see who knows if they actually have specialist cyber insurance cover in place. So right, if we could display the results for that on the slide. So it looks like around 50% of those in the audience know that they have specialist cyber cover. Around a quarter don't have any specialist cyber cover in place, and there's about a quarter of people who are unsure. So clearly some businesses have improved. That's a lot better than the statistics we saw from the ABI a few years ago, but there are still plenty of businesses that are going operating on an uninsured basis with respect to cyber risks. And one of the reasons, I suppose, that we do see businesses without specialist cyber cover in place is because people often have wide-ranging insurance policies, and there is an assumption that cyber risks will be included. One of the reasons for this is that the types of risks that can arise from cyber incidents are very broad. So not only do we have the risks of ransom payments, invoice fraud, fraudulent funds transfer, regulatory fines, but actually there's a huge cost in actually dealing with crisis management in a data breach scenario. In general, anecdotal evidence from people I speak to, actually IT remediation costs are often some of the biggest costs that people assume when they suffer a data breach, as are the costs of internal and potentially external regulatory investigations. The loss of goodwill and the impact from business interruption can also be significant. So all of these different types of losses add up, but they also sound like losses that might be covered by other insurance policies that businesses typically have in place. But one of the messages is don't rely on what we call silent or non-affirmative cover. This is when you might have another insurance policy, such as a property damage cover, and you would assume that property damage in a cyber incident might be covered, but there are actually good reasons why you shouldn't take that approach. I've got a couple of cases up on the slide here. They're not UK cases, but they do reflect a general movement in the industry away from recognising cyber claims under silent or non-affirmative policies. So the first we have CNG Oil of Indiana. Now in that case, there was actually a degree of computer fraud cover in an insurance policy. However, in this case, a ransom was paid out in the event of a ransomware attack, and the insured sought to claim from the insurer the amount of the ransom payment. What was found in that case was that although computer fraud was covered, it was designed to cover loss or damage to money, securities, or other property resulting directly from the use of a computer to fraudulently cause a transfer of property. Now, in that case, the ransomware actually shut down the insured systems, but the ransomware itself did not affect the transfer of funds. That was done by the insured itself in order to recover from the ransomware incident, and the ransomware payment was not covered by the insurance policy. There was another case, a very large case involving Mondelez and Zurich, in which Zurich refused to pay out on a significant $100 million claim under a property insurance policy when there was a significant amount of damage caused by a NotPetya ransomware attack. Now, in that situation, Zurich relied on a war exclusion under that property insurance policy. But what this sort of demonstrates is that if cyber coverage is not expressed under an insurance policy, then insurers will look to try to rely on exclusions and other reasons not to pay out under the policy. In fact, things have changed recently. So over about the last 5 years, the PRA has been recommending that insurers treat silent and non-affirmative cover seriously and correct their policies. So what we typically see now is that if you have an insurance policy like property damage or a general business interruption insurance policy, they may in fact expressly exclude any coverage for cyber risks to try to drive the insureds to purchase a specialist cyber policy where their adjusters and everyone else are properly assessing the cyber risks for the business, rather than treating it in an area where they might not have the expertise to actually quantify and analyze the cyber risk under a different policy. So if we move on to the next slide, I'll go through some of the key considerations when you're looking at cyber insurance. Now, as a partner in the technology outsourcing and privacy practice, when reading these policies, what I can say is that they're drafted very differently than what you might expect if you're au fait with general sort of technology contracts and privacy related issues. And actually they can take quite a lot of quite a lot of work to sort of unwind and unravel. So what I've got here are the headline items in this slide show some of the key variables that you'll come across in cyber insurance policies. So first of all, you need to think about the liability or the loss that's covered. Now, I've already gone through the fact that there are a broad range of damages that can occur in a cyber incident. There are claims expenses, there are recovery and remediation costs along with crisis management costs. Sometimes there are extortion or ransom payments. You can obviously be impacted as a business if you can't function as a result of a cyber incident. So that business interruption loss can be significant. And of course, this moves on to things like contractual liability and third-party claims and regulatory fines. Now, whilst there are a broad range of losses, they can arise from different types of incidents, and sometimes cyber insurance policies don't cover every type of incident for every type of loss. So the actual cause or type of incident covered is important to keep in mind when reviewing a policy. Now, most cyber insurance policies won't expressly refer to covering things like phishing and social engineering or viruses, but what you do often find is that when you read the policy, some of the cover might sort of mix the actual liability along with the cause of the incident. So for example, you might see line items in a cyber insurance policy to cover cyber extortion expenses, for example. Now that's going to be quite a narrow type of loss that's suffered as a result of a particular type of incident. So you need to think about what may or may not be covered with a variety of types of incident in mind. The other thing to think about carefully is what systems and services are actually covered by the cyber insurance policy. Now, I think there's been some movement in the cyber insurance market, particularly over the last 12 months of the pandemic, where people have moved to remote working. But actually, under a lot of the policies that we were seeing 12 months to 24 months ago, often the covered systems and services did not necessarily cover systems or networks that were off premises, or they may not have covered outsourced or cloud services except for example, business interruption costs. So what you would find is that there would often be exposures that you could have because you might have an outsourced contract or a cloud contract with a very low limitation of liability, but if they were to suffer a cyber incident which would cause you loss, you might not have the ability to claim that under your cyber insurance policy. So what I recommend when you're going through cyber insurance policies is to consider this carefully, and you can sometimes, if you're not happy with the systems and services that are covered, ask for endorsements from your insurer, and regularly brokers will help you to go through that process to make sure that you're covering your business adequately in respect of cyber insurance cover. Now, clearly the level of cover, the deductibles and the conditions are really critical in a cyber insurance policy. And what we have seen is that often there are a variety of different limits in cyber insurance policies so that they call out specific types of loss. Sometimes there are specific limits that are much lower than the overall cap. So for example, if you're looking at certain forms of property damage that can arise from a cyber incident, such as damage to servers, that might come under a much lower cap of liability than the overall aggregate cap that you might be offered under a cyber insurance policy. It's also important to think about aggregate cover versus per claim cover. Often cyber insurance sits alongside professional indemnity cover, because they cover slightly different forms of liability. But whereas professional indemnity cover is usually insured on a per claim basis, often cyber insurance is covered on an aggregate basis, which could limit the cover that you have in the event of multiple incidents. Clearly, the conditions of cover are very important. Some of the things to think about are what your obligations are to notify on your insurance policies, and also whether consent from your insurer is required when you're trying to actually respond to an incident. That's quite important to understand, and insurers often do provide ancillary services alongside their policies to try to help you respond to an incident, but having an understanding of that is key so that you're not left waiting for consent from your insurer if actually you do need to take quick action to spend money, for example, on IT remediation in order to recover from a breach. Finally, exclusions are very important, and these can be difficult to navigate. Regularly in cyber cover, there might be exclusions that direct you to other policies. So for example, you might see that employee dishonesty is excluded from cyber insurance policy because actually that might be covered under an employee liability or employee dishonesty policy, or indeed a crime policy. They come in all sorts of different sort of packages that insurers offer. But be careful of some of the exclusions that can be really problematic. So for example, in some policies that we've seen, there might be an exclusion if the insured has failed to take all reasonable steps to protect themselves from a cyber incident. Now that is going to be very difficult to get around in the event that you suffer from, for example, a phishing, ransomware or social engineering attack, where clearly it's going to rely on some sort of human error, and it might be possible for the insurer to deny coverage. So be careful of those when you're looking at your cyber insurance. Now, without any more ado, I've spoken for long enough. We have a brief period of time left, and it would be great if we could now open up to some Q&A. Leonie.
Thanks very much. Thank you, Stephen and Tony and James. Some very useful insights there. So yeah, I think we have time for a couple of questions, and we have had a couple of questions. So I think the first one is for Stephen. Stephen, could you give an indication of the time frame between the events that you described, so the incident itself and the recovery of the funds?
So we were notified by the client in the first week of August 2019, and the event had taken place, I think it was 3 weeks before that. So ultimately, you want to act as quickly as possible, but there was a period of time before it had been investigated. But because we acted incredibly quickly and got the freezing injunction within a few days of instruction, that then really held the fort. And we then got the first chunk of money, being the 11.5 million back, I think 6 weeks later. So it really was a quick recovery, and unexpected for a lot of people to think how quickly that can be. And then a bit more into the long grass for the summary judgment over the last 18 months to then work out the rest and to recover the costs.
Great, thank you, Stephen. And there's another one which I think is probably for James Walsh. So one member of the audience has indicated they understand that regulatory fines are not insurable. Is this really a peril that can be covered under a cyber policy?
Yes, that's a very good question, and the origin for this is sort of a legal principle known as ex turpi. I won't go through the full Latin, but essentially that a court won't lend its hand to an illegal or immoral act. Now, what's clear is that anything that's criminal related, so any criminal penalties, will not be insurable. The position on regulatory fines is a little bit more ambiguous, and what we tend to see in cyber insurance policies is some people will purport to cover them, but then will exclude coverage if in fact it's illegal to insure the fine, and others will say that they'll cover regulatory fines to the extent that that's permissible under applicable law. Some insurers are a bit bolder in terms of trying to provide coverage for regulatory fines, but I think the reality is, because GDPR fines are quite new, and because if you've got a specialist cyber insurance cover in place, there's probably an interest for the insurers not to take away the incentives, I suppose, of buying cyber cover. We haven't actually had a decision on the insurability of some of the more recent types of regulatory fines that we have. So, but actually, I suppose the assumption would be, when you're looking at large fines, if you look at the scope of fines, for example, in BA and Marriott, they'll often exceed the level of cover that we commonly see organisations have. Often we see policies with £5 or £10 million worth of cyber insurance, for example, if they're a medium to large sized business. So what we often recommend is that, well, it's useful to have. You can't guarantee the coverage until we have more from the courts on this particular point, but there's still utility in getting coverage, because what insurers will cover, for example, is the costs of handling the regulatory investigations, the costs of your lawyers, the costs of the forensic experts involved, the costs of handling court proceedings. So all of that cover is very useful and very enforceable, even if it turns out that a regulatory fine itself cannot be recovered.
Great, thank you, James. We probably can squeeze in one final question, which is probably for the other James. James, you mentioned that there's a Supreme Court hearing today that might pave the way to US-style opt-out class actions. Can you just say a little bit more about that for the final minute? Thank you.
Yeah, sure. It was very nice of them to put it on to coincide with our webinar, so well done, the judges and everyone at the Supreme Court. Over the last few years, we've seen a trend towards more follow-on litigation in the wake of data breaches, partly to do with GDPR improving transparency, partly to do with the claimant culture that's sprung up on the assumption that any breach is effectively a strict liability matter, leading to damages for loss of control of the data, distress, other harms to the individuals. The case in the Supreme Court is Lloyd and Google. It's one part of that direction of travel. It's the preliminary stage of an attempted representative claim, where one representative claimant brings a claim on behalf of a class of claimants with common concerns. But what's notable here is that the class of claimants is a notional class. It's not like the Morrison's case that you might have heard about, where several thousand employees opted in to a group action seeking damages in the wake of a breach, but instead it's on behalf of everyone in the jurisdiction who might have been affected by the incident. Most of them won't even know the litigation's happening. It's only the early stages of the claim. It's really driven by a funding model from litigation funders and insurers. I think the claimant had something like 30 million in insurance and ATE insurance and litigation funding at the outset, and eye-watering damages possible from these claims. So it'll be really interesting to see if the Supreme Court goes the same way as the Court of Appeal in supporting this move towards possible representative claims, and particularly these opt-out style class actions in the wake of data breaches. I should say one thing, it's a case under the old Data Protection Act 98, but many of the principles will still carry across to litigation that we'll see for years to come under the new frameworks.
Great, thanks very much. And I think that brings us exactly to the end of the hour. So thank you to all of the speakers for some really interesting insights. And thank you to the audience for listening. Have a good afternoon, everybody. Thanks.